All right. Hello, everybody. Hello. People are just rolling on in here now. Hey, everybody. Welcome to the Bitwave webinar, Fireside Chat, DeFi and NFT accounting success stories. This should be a lot of fun today. We'll get into it more, but I like to give everyone a minute or two to join. So we're gonna do that. While people are joining, what we're gonna do is we're gonna throw a couple polls up on the screen here. So feel free to go ahead and jump into these. First thing before we get started is this is not tax advice. You need to tax or accounting advice. You need to refer to a professional. We have professionals here that you can refer to outside of this call, but this is not tax and accounting advice. So please consult a professional, lawyers, accountants, CPAs, things like that for anything on the side of crypto. This is just some observations we have and things like that. So, all right, the first poll that we're going to do here is will your 2022 taxes, this is you personally or you as a business, I'm okay with either, sort of a choose your own adventure on how you want to think about this. Will your 2022 taxes include digital asset proceeds? But really any sort of digital assets. Are you going to be checking that box on your taxes that says you touch digital assets this year? So we'll give everyone about another minute to join here. So and then we'll just dive right in here. So little poll while we're all waiting is, will your 2022 taxes include digital assets on them? It's something that we're going to talk. I actually forgot to mention this when we were doing our prep for this webinar, but it'll be a good question to talk about. John and Dan we'll save it for later. Is it a major change how they kind of rejigger the tax forms, U.S. tax forms, to pull that digital asset question up earlier? We'll talk about that later, but it's a very interesting question about this. Okay, let's Courtney, let's close this poll out here. All right, what do we see? 68% said yes, 32% said no. It's really interesting because we've been doing a lot of these webinars, and I would say it's about 1/3, 2/3 tends to be the ratio that we always see for that. The webinar we did on Tuesday was all about NFTs, and it was whether you owned NFTs, and that was 2/3 said no, 1/3 yes. This is saying, will digital assets be on there? 2/3 are saying yes. I feel like that's pretty self-explanatory for a webinar like this. 33% said no. All right, let's get into it. It's 5 minutes in. Let's dive directly into it at this point. Before we get started, really quick bit of news. Bitwave, we wanted to post a little save the date. Bitwave is doing a conference. If you are excited about this topic here today, if this is the kind of stuff you want to talk about, if you are a business that's using digital assets, we have a thing for you. So the Enterprise Digital Asset Summit will be a enterprise and business focused summit happening in Austin, right next to Consensus. So if you're out for Consensus anyways, please feel free to stop by. We have discount codes if you email us at info@bitwave.io. The idea here is really just to give everyone a forum for those of us that are really working deeply with enterprises, Fortune 500 companies, businesses using digital assets. We want to create a forum for professionals to get together, and hopefully we'll keep the number of monkey suits and things like that to a minimum. It's really about serious people using serious digital assets. So, all right. Awesome. Here's a brief agenda for today. We're going to introduce the panel. We're then going to run into some success stories. We'll talk about what's going on in the industry. I have a lot of questions for our panelists. This should be a lot of fun. This will be a little bit riffy. That's the whole goal here, is to give our panelists a chance to kind of talk about their practices, how they see the world of digital assets maturing over time. And then we'll obviously be taking questions. Please, at any point, feel free to drop a question into the Q&A. We'll be monitoring that on our side. So always feel free to drop a question in there, and that's it. So this should be a lot of fun. First, to introduce our panelists. My name is Pat White. I'm the CEO of Bitwave. Bitwave is a leading digital asset tax and accounting solution for businesses that are using digital assets. So if you have a business using digital assets, we won't spend a lot of time talking about Bitwave today, but if you are using digital assets, please look us up. We help with ledgers, taxes, all that kind of good stuff. John Masotti is the managing partner at Masotti & Masotti LLC. John, would you like to introduce yourself real quick?
Sure. So yeah, I've been. We have a staff of about 20 people. And actually, the firm has been in existence for over 60 years. My father, grandfather, and uncle started the firm back in 1960, and my father's still working 12 hours a day. He's actually attending this webinar. He's also a huge believer in crypto. I think he just bought the dip again. So I've been practicing for over 24 years. I've really got involved in crypto about 6 years ago. But I mean, I don't know, Pat, do you want me to, kind of go through?
No, quick intros, fine. We'll dive into into the firm and how you guys look at all this stuff later. But
all right, good.
That's perfect. I didn't realize that this was a multi-generational family firm. That's really cool, man.
Yeah.
That's really cool, actually. Awesome. And then with us also is Daniel Winters. Daniel Winters is I think he called himself a tax accountant, but master's in taxation, MBA, and a general crypto enthusiast and deep in crypto tax and accounting. Dan, would you like to introduce yourself a little bit?
Sure. Hi, everybody. My name is Daniel Winters. I'm the head of globaltaxaccountants.com. We are a niche tax and accounting firm. We focus exclusively on cryptocurrency and blockchain. Our clients are high net worth individuals and businesses with digital assets on their balance sheet or their P&L. This is a smaller niche firm. It's smaller than John's, and essentially, I launched into this space as a tax accountant in March 2015, which is 7 years ago. If you go to YouTube, you will still see a video of me from the Texas Bitcoin Conference 7 years ago talking about Bitcoin and taxes, and I used examples where the price of Bitcoin went from $250 to $300.
Oh man, that's awesome.
Thank you, Satoshi Nakamoto.
Wow, that's amazing. It's fun. It's funny to think about that, especially as today we're seeing, $45,000 down to $35,000 in the course of like 2 days here. It is how the times have changed.
For anyone that's been in the space for a while, I believe Ether launched at less than $2 in August of 2000.
Actually, if you bought it at the ICO, and I know this for Bitwave, we have some of our customers are still carrying ETH at a 50-cent cost basis. Like if you bought in early buy-ins on the ICO, were about 50 cents. So pretty good way to.
Yeah, I thought it was 30, but hey, I thought it was 30 cents. But in any case, but yeah, so kind of going back to tax here. So very broad experience, starting with clients like Bitcoin miners, moving through to individual traders. Still have a split between high net worth individuals and businesses. And I think coming up later, I've got a good success story of how I used Bitwave to handle some very significant cryptocurrency accounting issues.
Oh, perfect. John, Dan touched on it a little bit. What got you into crypto originally? 5-7 years ago.
Well, so what happened was actually a client of mine invested $100,000 in Bitcoin back in, I guess it was back in 2013. So that got my interest, right? He was talking to me about it, and he really approached it the perfect way in hindsight. He said, look, do you know anything about this? And I said, no. He goes, well, look, read about it, research it, and I'm here for any questions you have. I think it's going to change the world, but, just research it yourself and let me know what you think. Of course, I didn't do that, but I followed it, in 13, 14 through Mt. Gox, 15, 16. Then what happened was I met with a hedge fund manager, Murray Stahl from Horizon Kinetics, and they were, pitching a Bitcoin fund. And so I met with them with my family in the summer of 16. And, I did some research prior to that meeting, because I was somewhat familiar with it, but that was it. It was that meeting. I fell in the rabbit hole and I still haven't come up for air since, so that's, and then it was really, Bitcoin and Ethereum at that time. And then, and then it was really just diving into, well, how is this going to impact within a few weeks? I was diving into, well, how the hell is this going to impact, accounting? And I started reading different white papers done by the big four firms, and it just blew my mind. And then everyone in the firm kind of looked at me like a one-eyed monster for a year or two. But now I pretty much got, all the buy-in It's an old, we've been around for 60 years. We got 250 years of combined experience. But the buy-in has been really, really, really good at the firm. So yeah, we've just been, I can get into that a little bit too. Just kind of
I think that actually segues really well into what we wanted to talk about here. I mean, a couple of things we want to talk about is sort of the evolution of blockchain, the evolution of blockchain accounting. I know you sort of tend to spend a lot of time thinking deeply on this. How has the blockchain evolved over the last few years? How has it started to change accounting? What do you see? And then what do you see kind of going forward in terms of how this will impact accounting here? I love sort of thinking about that. And I'll preface it by saying, like, I think that maybe 5 years ago, there was this thing where everyone's like, blockchain's gonna, no accountants will have jobs. And like blockchain's just gonna like we're never, like, no one's gonna have to have accountants anymore. It's all gonna just deal with it. That has certainly not been my experience. It seems like there are now more people worrying about crypto accounting than there are about normal day-to-day accounting. So yeah, talk about that a little bit.
Yeah, well, I think it's ridiculous right now. We love it. It's like I don't call this work. I mean, it's a true passion for me, and to be able to then intertwine this passion of crypto with my profession, with my firm, with what we do day in, day out. It's just, it's like a dream. It sounds corny, but that's how I feel. And so I just think that, certainly accountants, the role of the accountant is going to change dramatically over the next decade. And right now, working with you guys, right? And this incredible software you have, right? It's like a Ferrari on a road built in 1903 for a horse and buggy, because it's just the infrastructure is not there, but Bitwave and some of these other, for now, Bitwave is that Ferrari, right? It's got so many, it's really automating things tremendously for us. And, but over time, I think accountants are going to play a huge role in adoption. People just dismiss accounts. First of all, 99% of accountants don't know what Bitcoin or know what blockchain is, period.
And perhaps don't want to, I think.
And don't want to. And then
might be a good way to say it.
And then 99.9% of accountants don't even know what a blockchain explorer is or how to navigate through it. No way. And so, and like I explained to, my firm, these are businesses that are doing transactions outside the banking system. Sounds bad. But it's not. It's super innovative and super cool, and it's transforming, and it's the plumbing of how we transact is changing dramatically. And as accountants, how do we not really want to learn about this? It's an accounting system at its core. That's why we trademarked this years ago. But real quick, I think what's going to happen, I still use the term triple entry accounting. We have courses that we've created. We've partnered with Wiley as our distribution partner and Accounting Blockchain Coalition. So, we're really into the education.
Describe that term really quickly, because I'm not sure it's the most immediately accessible term. So triple entry accounting. I mean, everyone on this call is, I'm sure, familiar with double entry, which would be you have two accounts. But what's triple entry here?
Okay, so I'll explain it the way I normally do, and then Daniel, I'd love your take on it, because there's a lot of different ways to kind of look at this. But the easiest way to explain it for me is, if Pat, I was going to send you $5,000 for consulting, I'm going to credit my cash in traditional, double entry, right? And I make that payment, via wire or whatever through the traditional, banking system. I'm going to credit my cash. All right. I'm going to debit consulting expense. You're going to debit your cash and credit, consulting income. I'm going to reconcile with my financial institution on my ledger, and you're going to do the same. Now, if I were to transact, or if we transacted on a blockchain instead, I sent you, Bitcoin, then what would happen is we don't have our own ledgers. We share that ledger. I get the credit of 5,000. You get the debit of 5,000. The third entry, the triple entry, is a cryptographic timestamp on a blockchain. So what that does is think of it kind of think into the future, where someone, walks across the street to the, variety store, and they purchase $100 of product. So then they're going to pay $107 to the merchant, 7 of which is sales tax. That merchant then at the end of the month is going to, file either they are or their accountants are going to prepare a sales tax return, which is what? It's a reconciliation, right? And then they're going to, make the payment of $7 to the state of Connecticut. Now, turn that into a triple entry, or if they made a payment with a digital wallet, right, with crypto. So now the state of Connecticut would share a node on that network, and then say it's me, and I'm going to make that payment via digital wallet via crypto. I'm going to transfer $107 of value. $100 is going to go straight to the merchant. The other $7 is going to go straight to the Department of Revenue. It's through triple entry accounting. It's reconciled in real time because we all share that ledger. And the state of Connecticut gets their tax in real time, and with no need to reconcile because of triple entry, and you don't need to report that transaction on a sales tax return. So just imagine what that'll do it'll eliminate the need for sales tax returns, eliminate the need for payroll tax returns. It's the same concept. All right, we have the federal government, state government, all sharing nodes on the network. And then I go a step further. It's only common sense that ultimately they'll change the tax code for on-chain transactions versus, say, off-chain, which is, in the traditional banking system.
Although it's certainly worth saying that ultimately it can be might be a few years out.
Oh yeah, absolutely.
might be a few years out.
Absolutely. But I say within the next decade. It sounds crazy, but once the government really, and governments throughout the world, once they implemented CBDC, game over. That's a double-edged sword, CBDCs, all right? But the fact of the matter is, for adoption, it's massive, because governments will not be able to turn down that massive benefit of receiving tax payments in real time. They won't be able to do it. They're going to do whatever they can to have that structure. And so, and then you have to have some type of different tax code for that. Whether it's a flat tax or whatever the case may be, it has to,
So to kind of sum up what you were saying there, which is, so to really close out the triple entry piece really quickly, the idea behind triple entry.
I want to geek out on that for a minute.
Yeah. I love your feedback too, Dan. Of course, Pat. I love what you guys think about that kind of, thought process, and if you think that that's really going to happen. I'm convinced. For the record.
All right, so I guess it's me then.
Yeah, go ahead, Dan.
Yeah, no, well, yeah, triple entry accounting is a fascinating topic. I'll try to sort of hit the highlights here, but the seminal paper on this was written by Ian Grigg, Grigg, before blockchain was created, because he conceptualized the system of triple entry accounting before there was a blockchain. Ian he's been in digital currency since the 90s, and is one of the people who was hanging out on the original cryptography emailing list where Satoshi Nakamoto, the Satoshi Nakamoto team, perhaps, were discussing their interesting new technology. But so, yeah, eventually we're going to move to it. With mass adoption of blockchain, what'll end up happening is some type of stable coin, which is just baked into a browser or a phone, and that people can just use it unconsciously without having to think about the tech in the background, kind of similar to the way WhatsApp has end-to-end encryption, but they kind of just said, oh yeah, we have this feature now, and no one needs to think about it, and it just works, right? But obviously the foundation of a blockchain really is accounting, because it's a transaction from one, and it's a single ledger, right? Ethereum, it goes in and goes out. Those are the only things we can kind of see in and out, right? We can get a lot more detail. As of now, we need, and I think we still will need, Bitwave is a really powerful tool to perform those reconciliations and be able to categorize these transactions so that they can get out into a profit and loss statement and to a company's balance sheet, right? And so it's triple entry accounting in general it's a fascinating topic, and then we could talk about maybe another day the difference between a CB, a central bank backed stable coin, and a non-governmental stable coin. And
well,
kind of the
then
difference
even
between
a fiat-backed stable coin versus a algorithmic stable coin is very
exactly. And it's an awesome topic. And they invited me back to Austin to a different Bitcoin conference in 2018. And I actually closed my presentation talking about, okay, on the one hand, we have, the soon to occur central bank digital currencies. And on the other end, we have MakerDAO. So my question to the audience is, well, who do you think is going to develop a better, more user-friendly, system here? A blockchain startup or the government?
It is an interesting question. I mean, but now technology per usability does not always win. Like that's one of the things is that adoption can drive winners in markets as much as usability can. So that's why when you look at CBDCs, they'll ultimately win not because of usability, but because all the banks will end up adopting them. And that will be sort of the big turning point for a lot of this is when I can send, when I can take fiat, put it in my bank account and suddenly have a digital asset to immediately spend and do whatever I want with. That will be a major turning point on this. And you're starting to see that there are banks today working on this idea of, having a, kind of a neo bank where you can deposit USD and then have USDC on the other side of it. Now, what becomes really interesting about that, though, is that those banks tend to monetize on that conversion. And I talk about this a lot, which is, I know we're getting a little bit like off topic here because it's a little more philosophical, but like we're starting to see a lot of businesses that are popping up monetizing around taking transaction fees. There's like some of the multi-sig wallets. And we have a multi-sig wallet that we don't charge transaction fees on. There are multi-sig wallets out there that do charge transaction fees, which I think is crazy because you're paying the ETH fee itself. Like in this peer-to-peer world, fees should really start changing quite a bit. Like fees should be paid by the user and then maybe a small fee going to whoever's providing the service in terms of liquidity or whatever. But the idea of central people charging fees is hopefully something that's going to kind of go away. And I think that's one of the other really powerful things about blockchain is it's not necessarily about the decentralization, although that's great. It's the disintermediation. In some ways, it's so important is making sure that you actually can kind of have you can do all this stuff peer to peer, and now there's no one in the middle who's going to be taking a 1% fee when you're doing your credit card transactions or your payments or whatever it is. So, yeah, super interesting. Well, John, let's get back to you a little bit here because I know you wanted to talk a lot. You wanted to talk about sort of success stories and failures and successes and things like that sort of have led you guys to where you are today and have helped you build up. I mean, you want to talk a little bit about some of the big successes you've had?
Well, yeah, it's probably more about the failures, but yeah, no, that'd be great. I mean, our success story in DeFi, that really didn't start happening until we started working with you guys with Bitwave. I'll get into that in a bit, but and basically, I kind of view like every day in this space is really it's really like a series of failures that ultimately create this success story. At what point is it success? And so, and again, when it's your passion and when you love doing this stuff, it's really about the journey and the knowledge base and continuing to learn and evolve. So I mean, if like I said, I've been involved for almost 6 years, and again, I failed in many areas within the space, but I think failure ultimately breeds success, right? So basically in 2017, we almost set up, I got a bunch of partners together and then we almost set up a mining operation in Norway. It's a long, funny story, but I don't want to bore the group here. But my partner basically picked the short straw and he went to Norway for 3 days for the final due diligence process. And then we couldn't move forward because our tech partner really couldn't perform as promised. But we spent months putting that deal together. We had a soft commitment from a hedge fund to co-invest. It was like after 2 meetings. So we were on top of the world and then it all fell apart, right? But on one hand, is that
that kind of is reminiscent of crypto in general sometimes.
Yeah, exactly. It was on one hand, it was failure because the deal fell apart. But on the other hand, I mean, it really was a success because we learned so much going through that process. And so then in 2018, we launched an advisory called Blockchain Advisory, and that included 3 main pillars of services. 1, consulting on various blockchain use cases. 2, BBO, blockchain back office accounting, right, for businesses and individuals. And then the 3rd pillar was creating blockchain curriculums for universities. Well, BBO, it was too early. There wasn't enough adoption and businesses weren't really using it. The curriculums, that didn't happen. I mean, no one took it seriously when we talked to the different universities. But the use cases, what happened was a potential client, wanted us to explore a blockchain-based rewards platform. So we built one, right? We had a successful pilot at Lionsgate headquarters, actually, in November of 19. Really big names were involved. We signed somebody up, but we ultimately pivoted to, building an NFT marketplace. Now, I ended up taking a passive role in that venture because my focus is really on blockchain accounting and education. So, and again, that venture may blow up in a good way or a bad way. Is it a success story? I don't know. But at the end of the day, to me, no matter what happens, it was a success story because the experience that I acquired was priceless, right? I mean, and to be able to build and see that side of the technology and that process as an accountant, which was what my clients are doing, it was priceless for me. So then what happened?
Yeah, that's really fun to kind of think. I mean, I think it ends up similar to kind of my story in this. I mean, in kind of the broader sense. I mean, at the end of the day, anyone who's building a startups are this this might not be relevant for this call, but I like to personally talk about how startups are this. People think of startups as kind of this up and to the right venture, and sometimes they work, sometimes they don't. Startups are this like horrific roller coaster that you're on with no seatbelt essentially, and day after day, every day is like either the best day of your life or the worst day of your life, like day after day. It's all about learning from your failures and then just sort of getting back up and going after it. But I think, John, one thing that's super interesting, and I want to kind of poke at a little bit is we talked a little bit about kind of like personal failures that we might have gone through or personal things. But there's one interesting part of this, which is there's also some kind of systemic failures here. So one of the systemic failures that I want to talk about a little bit is impairment. And I know that's sort of a funny segue between those, but there's a lot of baggage that has gotten pulled along into digital asset accounting that if you were designing accounting today, you would not be like, oh, we need to do impairment on this stuff. But of course, because we have to follow US GAAP rules and all this kind of stuff, you have this sort of systemic failure of, and it might not be a failure, it might just be more, being conservative. You have this notion of FASB and different organizations wanting to sort of see how things go and saying, yes, we need to have impairment. Like, what do you think about something like impairment, which is really kind of a controversial issue? I mean, it's not controversial whether you have to do it or not. It's controversial whether we should be doing it or not. And certainly that's.
No, I think it's, my professional opinion. I mean, stupid. That's my professional opinion. Like, I mean, I think that, part of the problem is education in the space. Part of the problem, if 99% of accountants do not really understand what blockchain even is, then, in crypto and how, I mean, I think I was actually, I'm part of ABC Accounting Blockchain Coalition. So we went to a 6-week thing where, David Deputy, the president, was doing a demo on DeFi every week. It was awesome. He was navigating through Aave and doing different transactions, entering different liquidity pools and things. And so then we were talking about the taxation and treatments and potential treatments. And so then, but my point is, at the end of it, I said, this was awesome. There's so many accountants on, like, but 99% of accountants don't understand what blockchain is. How are we going to explain what DeFi is?
Yeah.
And so,
it's
simple. Yeah. And so,
it's like a piece of cake.
They're like, D what? And then, or actually, I haven't heard this in a while, but I heard it for years. I'm like, so you guys involved in blockchain? These are accounts, block what? So now it's like DeFi, D what? But so what we evolved into is, doing the blockchain back office accounting services for crypto businesses and individuals. And then we rebranded that Blockchain Advisory to Blockchain Academy. And that's where we run our courses out of. So we have 4 courses that we created. One's on blockchain, introduction to blockchain and triple entry accounting, another course on tokenization of assets and the impact on a balance sheet. Third course is taxation of digital assets. And the fourth course is the overall impact that blockchain will have in the accounting profession. But so we, but again, my whole part of our mission is to educate ourselves, because I tell everyone, the more I learn, the more I realize how little I know. That's it. Yeah. But it's about educating ourselves, educating others, and back to the impairment issue, right? Is that, accountants need to be more informed, right? You can't, people making these decisions, are they like Michael Saylor said, show me one person that has studied Bitcoin for 100 hours or more that doesn't see its value, right? So it's like I tell people, lastly, real quick, I tell people that that have opinions on crypto because they watch a CNBC interview or they read some bullshit article about, pardon my language, but it's like my wife, she has a book club. Every month they meet for a book club. They have 20 questions. They really are serious about this. And say it's a 350-page book. Say one of the 10 people that go every month didn't read the book, or no, they read the first paragraph. They can't participate in the meeting, in the book club. They're not going to know anything. They can't discuss the questions. And so that's what the problem is.
That's the media and a lot of accountants.
It's all this noise. Yeah. And then so I think that, there's got to be this fundamental drive and push for education, blockchain education. Why is it not a more a part of the CPA? They're talking about enhancing the CPA with artificial intelligence, data analytics, this and that. But what about blockchain?
Which is arguably one of the biggest financial movements. I mean, much more so than AI and stuff
Absolutely.
like
that. And is AI, is data analytics, is that a block? Is that an accounting system? No, it's not. Blockchain is.
So Dan, what's your take on this, buddy? So we kind of talked about like impairment a little bit. I mean, what do you think about impairment? What do you think about other kind of failings from traditional accounting as it applies?
I mean, I wasn't really going to get too much into impairment. I was going to say, what do you mean blockchain is one of the most important financial innovations? It is the most important financial innovation of our generation. That's what I'm doing in this space. That's what we're all doing in this space, right? Because of potential, right? But yeah, as far as impairment, Pat, can you go back to can you recap your question again? Sorry.
Well, just, what do you think are other carryovers that are impacting, like us as accountants, that we're kind of having to carry over? Like things that I can think of would be wash trading rules. I mean, that's, or the lack of clarity around wash trading rules, impairment. There's a lot of stuff that sort of has a more traditional, like even the idea of cutoff times is a very interesting legacy, at this point, legacy concept in some ways, because crypto is 24 hours a day. Like we do, our cutoff time for Bitwave as a piece of software is 11:59 p.m. for your local time zone. I mean, these are really hard questions. Like what are other kind of like legacy issues that we're sort of dealing with in this space around from traditional accounting and tax issues?
Sure. I mean, from the start, when I first got into the, started doing what I thought, when I entered the Bitcoin, the Bitcoin space, right, is records. Dealing with cryptocurrency records is challenging. And it's challenging because you need an outside system to keep track of what you did. And my early, some of my earliest experiences were, going through line by, one transaction, line by line, a report, from Coinbase, and then sending it back to a client saying, you can't always tell what it is. Okay. Right. And transfers, what was, and you basically send back a spreadsheet, with a comment field with a whole bunch of question marks, right? Because, unless, if you're transferring something out of Coinbase, unless you enter a transaction description, nothing's going to be there. People either don't want to do that because they think it's a privacy issue, or they just don't do it, right, for whatever reason. So yeah, looking at the tips, more transactions, no more problems. Well, the need to integrate records from multiple different sources, whether it's a centralized exchange and now decentralized exchanges, it's a critical thing, and it's the essence of what we're doing as accountants in order to be able to one of the primary functions is reconciliation, which is also here, and that's that. I saw the need of a platform like Bitwave 7 years ago. Okay, it was necessary. Okay, I knew what I needed to do my job basically for years. And it took a long time for things to emerge that were capable. There were some early attempts. And from what I could see for a long time, the systems to do true blockchain accounting were basically rather expensive rather expensive and proprietary, right? And I don't know what KPMG or big, really large accounting firms were doing back then, right? That's sort of not the space in which I work. I operate in the, entrepreneurial startup space, right? But Bitwave can essentially, really, it is my best friend. It is the most sophisticated, crypto accounting system that I've seen. And it's allowed me, my firm, to do some phenomenally complicated, sophisticated stuff, which I'd be happy to talk about.
Nice. This is probably the nicest anyone's ever been to me. This is awesome.
Well, look, I've been doing this for a long time, and I spent a lot of time dealing with tools that weren't quite up to it and requiring significant manual input from myself, right? And you can get things done, manually. It takes a long time, so like we were kind of talking
let's actually talk about that just a little bit, because I mean, one of the things that you've worked on is you've worked on customers with very high transaction volume.
Exactly.
It's something that I talk about this a lot, that like it's a crazy world. Like, there are startups, we have customers that essentially in the last 18 months have gone from 0 transactions to 10 million a year,
Okay.
If you were to define, like, if you were to see a retail store like that, I mean, like 10 million revenue transactions event is more than most retail stores see every single year, let alone an 18-month-old startup. And so this idea of like this explosion of transaction data, because at a retail location, you would grow into that, right? You would start with one bookkeeper, because you'd have one store, one bookkeeper. You would kind of grow into your transaction volume. At some point, you'd add some robotics. At some point, you'd add more bookkeepers offshore, like whatever it is, you would grow into it. But we have companies that are going from 0 to 10 million transactions in 18 months, and they're skipping puberty essentially. And so like, this is like, you kind of had a similar thing. You had some clients with very, very high transaction volume. How do you think about those problems? How do you help them? How do you even conceptualize millions of transactions?
Sure. Yeah. I mean, this large project I mentioned before, I mean, the transaction volume wasn't that high, but essentially, what I had the opportunity here was to organize and design the cryptocurrency accounting system, from the start, right? And the beginning of this was, okay, there are different wallets. Okay, so we know what the wallets are. Okay, and one of the first steps when I'm discussing clients' transactions are, is there a particular pattern of transactions? Right. It's important to understand the patterns that people do, because they tend to, whether you're an individual trader or, a business, there, patterns repeat. Right. So, and essentially, really, for most of the time in a blockchain wallet, what you can see at a fundamental level is in and out. Okay. So, and then, well, in discussion from the client, we were able to, create transaction rules, because there was a very clear pattern for what was happening. All of the inbound transactions, generally signified one thing. And most of the outbound signified one thing. So you can create a rule in Bitwave so that all, for example, all inbound, a deposit, is revenue, and, a transfer out, rather. I'm not sure Pat, what we use terminology, a deposit and
deposit, withdrawal, transfer. I don't know. It's all new terminology. We're all making this up as we go.
Withdrawals, and expense. So you can set our broad-based rules, but the fact is, not every, and whatever your your wallet is. I mean, it's kind of like, you know, in a bank account, right? In a company bank account, not every deposit into the bank account is going to represent revenue for the business, right? It could be someone, you know, the repayment of a loan, or you know, any number of things, right? It could be a capital contribution. So, and this is why it's key, and this is the struggle to set up a system from the beginning so that the client can track what occurred. What more often happens, really, especially in early stages, okay, here's the transactions, what happened?
It's not, and also, I mean, often in early stages, it's not even here the transaction would happen. It's like, here's my wallet. This was my personal wallet until maybe about February 15th, maybe a little bit longer. I don't know, something in there. And then maybe I did some personal transactions after, and maybe there was some business work before. And you end up this commingling issue that really, I mean, most you run into this in businesses also, where you're kind of running your own business out of your bank account until you get to a certain point. But people tend to be better about getting bank accounts for whatever reason. I think just because, you know, crypto exploded in such an interesting way. But Dan, I mean, I think that what you're getting at is incredibly important. It's something that we at Bitwave, we tend to call this wallet hygiene, which is this idea of thinking, being very deliberate about your wallet structures of your organization, being very deliberate about how you know, what you're actually, how you're depositing money into that, how you're structuring that, you know, and it gets into things not just in terms of accounting, but in control also. So the worst case, like, crypto is one of those things where you really do end up with these control issues, these sort of, like, what would be a more traditional treasury management issue, which is you have these wallets with millions of dollars in them that you don't always exactly know who has access to them. So you obviously, like, you have wallet hygiene in terms of, we want to build a system that allows us to do automation and really, really powerfully automate our accounting and bookkeeping. But the other side is, like, we also want to know that if XYZ person gets hit by a bus, that, you know, someone else has access to the funds, or if someone who runs away to Aruba, you know, with a bunch of money, that we can claw it back, or we have monitoring controls on, or whatever it is. It's sort of the first time that businesses have had this issue where an individual, I guess maybe armored cars are like this too. I hadn't thought about this, but like, where an individual can control an enormous amount of money, and the business is holding the fiduciary responsibility for it, and you're kind of in that tough situation there. Yeah. So Daniel, all good stuff here. You want to talk about some of your other successes? I know we talked about kind of some of your big transaction volume successes, but do you want to talk about some of your other kind of client successes, and you know, tips and tricks and strategies to make life a little bit better as an accountant?
Sure. Yeah. I mean, I could probably flesh out the other Bitwave success here, but the essence of that, you know, that success story is being able to use Bitwave to review, categorize and reconcile, you know, multiple different wallets with a high volume in terms of transaction, number of transactions and dollar value. Okay. Then export these, get the dollar values of this, export them out to an accounting package. It worked. and it reconciled to the dollar. Okay. That is about the biggest plug that I can, you know, success story that I can come up with. Okay. When you get it to $1. Okay. Yeah. That's good stuff. That's good stuff.
How do you think about reconciliation more in general? Because there's sort of like there's the first level of reconciliation, which is capture transactions and make sure you're getting them for tax and accounting purposes. But like, how do you think about like the next level of reconciliation, like the audit side, you know, how you're actually like verifying that everything is correct, you know, and then some of the more challenging stuff to reconcile, like DeFi transactions or things like that?
Sure. Yeah. I mean, my firm does not do auditing, but our involvement with auditing, it wouldn't be a financial audit that from time to time, you know, when necessary, we'll be involved with, you know, say an IRS audit or blockchain audit. Not a pleasant experience, I would say. And just, it's a totally different topic, but for anyone out there that's listening, the IRS has extremely smart, extremely knowledgeable people who have a deep understanding of the cryptocurrency space. Okay, I've had direct contact with some of these folks. Okay, and they really know what they're doing. People, I mean, look, I take Twitter with a serious grain of salt. Okay, a big grain, rock salt. But there's so not all of them, but
Right.
there's definitely a core group of very well informed people who deeply understand the crypto space. Okay. And just, for clients who are listening and think maybe, they don't know what they're doing. No, they do very well, in fact.
100%. I always say that don't poke the bear. And actually that actually leads to a great next point here that I'll ask to both of you guys. So Tennessee, there was that decision that came down from the IRS to refund the staking revenue to those to the couple that basically sued for it was like $3,000. I mean, they must have spent tens of thousands of dollars like going after this. And the IRS did agree to return the staking revenue, and they're kind of taking a position that staking revenue is not revenue to recognize there. And I think this is one of those cases where, like, the three of us on this call, we all get on calls with people who are like, but what if I did? But what if I did? But what about this? It's like, guys, like don't get, like, my general advice is, like, don't get super clever with the IRS, because like they might move slow, but that doesn't mean they're stupid. What do you guys think about, what do you think about the Tennessee decision that came down? And, like, are you changing how you're advising your customers to reconcile to recognize revenue?
Yeah, if I could. So yeah, Pat, what you're talking about is the Jarrett case, Jarrett. And it's a married couple who had a fairly modest income from staking Tezos. I can't remember the exact year. It might have been 2019. The court decision is that, well, not the court, the IRS agreed to refund, not the revenues, but refund. The IRS agreed to a small refund of the tax on this. It's about $3,000. So the dollar value isn't important. There was some very poorly written articles about this that came out right away. And I would have to say, written by people who didn't really clearly understand the topic.
That stuff's hard.
That's why they shouldn't have been writing those articles. I don't write articles about automobile transmission repair because I don't understand the topic, right? So, I stick to what I know. So what does that case mean? For everybody but the Jarretts, it doesn't mean anything. There is no what's called precedential value. What am I changing in terms of my, advice to clients on the treatment of staking? Nothing.
Yeah.
The Jarrett case, there's a death trial, I think it's called. There's a trial set to begin in a year from now. Then there can be an appeals process. It could be, and likely will be, years before anything is firmly established there. So in the meantime, it doesn't change anything.
Yeah, that's no. John, do you feel the same way from your side? Or did you turn around and say, everyone stop reporting staking revenue?
No, Daniel summed it up perfectly, and that's our opinion as well. And I think that when it comes to this lack of guidance, right, there's a guidance in 14, in 19, the FAQs. I mean, you have to come up with, make decisions and, that are analogous to the code based on the guidance we have. And then you could take, more conservative positions, and then maybe a little bit more aggressive positions. Now, every position you take on a return has some risk associated with it,
crypto, touching crypto in general has some risk associated with it.
Oh, yeah. But then I think the most important thing is that you're consistent in what you decide to do. You have those discussions with the clients. You look at, the different options that are out there. Some may be more aggressive than others. But the fact of the matter is that you're better off just documenting. I think Daniel mentioned this about documentation, and more documentation and consistency. So it's better to be, it's better to be consistently wrong than it is to consistently take
inconsistent in your application.
Right?
Yeah,
yeah,
absolutely.
So you gotta. It's critical to. We have discussions with the client. We go through our onboarding document, which is very similar to Bitwave's onboarding document, and we go through all of the, come up with their tax and accounting policy statements, and then we make the decision, and then we stick with it, and we're very consistent.
How do you, so that actually leads we got a question in from the Q&A here that I think is fun to chat about, which is, what are some of the SOPs that you guys kind of recommend to your clients around digital assets? I mean, what are you telling your clients to do, either to make your life easier or to make their auditors able to audit their assets, I think, after the fact? I mean, what are some of the SOPs you guys recommend?
You want to go? I got to ask the question. Can you explain SOP? I'm not that familiar with that abbreviation.
Well, it would be like, the standard operating procedure. So like if you are a shop that recognizes a lot of revenue, you're going to have SOPs around how you do your revenue rec. How, like, we recommend people set up SOPs for creating new wallets. Crypto is it's so easy to create a wallet. I like to call crypto the unholy love child of a bank account and a credit card, because it has kind of all of the downsides of both. That at your corporation, you see crypto wallets spring up like credit cards, like boom, 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 boom. You see them, a new one every single day, but you have liabilities as the organization as though it were a bank account. Like if someone takes their crypto, runs away, there is no Amex that will go and hunt them down and basically clear that for you. It has all the liabilities of that. So, you want to be creating standard operating procedures around how you get notified of new wallets, how you are going to track revenue across wallets, how you interact with your auditors, and what documentation you save on a monthly basis. John, what do you kind of recommend?
Yeah, it goes back to the tax and accounting policy statement that we create with the client as part of the onboarding process. So we have all of their wallets, all the exchanges. We make sure we have every single wallet, every address, and then what we'll do is we go over their different tax treatment, right, and accounting treatment. What they're using for they're using FIFO, LIFO, high price in, first price out. We go through everything. What events are taxable? They're going into liquidity pools. They're getting the LP tokens. Is that a transfer? Is that a conversion? We talk about both, the different options, and then they make a decision, and then we stick with it. So then those are our standard operating procedures that are being created as we go through that onboarding process with the client.
That's our experience as well, is that basically, at this point for us, we have a stack of 10 to 15 questions that I like to think of as are not settled even remotely close. So like, for instance, ETH to WETH, whether that's a trade or a conversion or containerization. So whether ETH to WETH is a taxable event is a great example.
I don't think it is.
Yeah. John, what do you think?
I don't think it is, but I don't know what IRS thinks. I mean,
so Dan says no. You say no. You say
yeah, maybe. Yeah. I mean, yeah. There's no guidance on this. Yeah. I mean, and one of the. I don't know if I want to go on record.
Yeah, okay. You don't have to, buddy. You don't have to.
Yeah, but there's a.
We won't put you in the position to say anything, but what I will say is that's the kind of question that, when it comes to like SOPs, what you want to do is you want to create a document early on in your journey around this that answers questions like that. There's no, like today, there is no right answer. I mean, I think that's the fairest thing to say, is there's a lot of arguments to be made in either direction. There is no necessarily right answer. And as John was saying, it's all about risk, right? So for us, like we have clients that have Ethereum at a 50-cent cost basis. For them to go into a liquidity pool with a big chunk of ETH might basically bring in an enormous capital, what I would call a ghost capital gain, if they just come out of that pool like a week later. And so for them, they're making this risk assessment of saying, okay, when I go into this pool, I'm going to choose not to recognize this as a disposition, because that would be a $98 million capital gain. And yes, I know it's risky, but gosh, that's a lot of taxes I'd have to pay on that. And so the risk reward is there.
Yeah, the issue. Yeah, this is where we get into really challenging stuff, where there is no, essentially what we have here are new novel types of transactions.
Mm-hmm.
Okay, and I spend a lot of my time either reviewing transactions to determine what the heck the consequences are, or more like, or being presented with a situation here. I'm considering doing this. What are the consequences going to be? Ideally, you want to do this analysis beforehand. That's not always the case. That's not always the case. So, I mean, we're waiting to see what the IRS says for things about compound, liquidity pools and compound ETH. I think it's important to note, I mean, that, like at the top levels of U.S. government, like there was a working group in the White House, that issued a statement about this. And I think it's fascinating that, 7 years ago, I gave a talk to like 150 people in Austin, Texas at a conference that had, a few hundred, of early adopters, and people were very enthusiastic, about what's going to happen with Bitcoin, right? And now we have the White House with a working group about this. We have top ministers of finance in G7 countries. Like, I'm not going to say, oh, crypto's come of age, but to an extent it has.
I think it's fair to say that crypto's. Oh, Dan, I think it's 100% fair to say crypto's come of age. I mean, Christ. California released today that they might start accepting tax payments in crypto. I mean, if that's not crypto coming of age, is the biggest state, seventh biggest economy in the world, saying that they're going to take tax payments in crypto. I'm not entirely sure what is. John, question for you, real quick, buddy. Do you think this is tangential to everything else, and this is a fun question? Do you think it is actually very notable that the IRS changed the location of the cryptocurrency? Have you used cryptocurrency this year? Checkbox on the individual forms, brought it up to the front of the forms, is asking that as a much more prominent question this year. Is that relevant? Does that matter?
Well, I mean, right. So I guess because in 2021 it was on the front page. Now it's on the front page again. 2020 it was on the front page. Right?
I think 2020 was like buried pretty far down, right? Like
2019 it was buried.
Oh, 2019 it was, yeah.
Yeah, it was on schedule 1.
Yeah, exactly. And then 2020 it was on the front page. Now it's on the same line on the front page for 2021, but they just modified it to: did you receive, sell, exchange, or otherwise dispose of any financial interest in any virtual currency? So, I mean, I think you just, you got to make sure that all clients check the box if they're involved in any way, shape, or form. And, what is, we could dive into that too. I mean, in terms of receiving versus selling versus exchanging. And then what's disposing of any financial interest in a virtual currency, right? So, anyway, but it's definitely something that's important. It's definitely got to be addressed, and you got to check that box.
Yeah, don't perjure yourself by not checking that box. That is not the right thing to do.
Check the box for crying out loud.
I would add, if you check the box, report the income.
At least have like the line item that says
it's a secondhand story, but I was speaking to someone recently and he basically said, oh, well, I know someone that he checked the box, but I don't think he's putting, reporting on his return. And I said, well, that's a bad idea.
That's okay. Like that might trigger some interest from somebody.
Yeah. I mean, so I mean, it's the fact of the matter is, regardless of where the question is, if an accountant is doing your return, then the software should ping them. There should be
So that's actually a great point, though, Daniel.
You're forced to answer the question.
No, it's actually a great point.
I don't know.
One of my friends that uses a CPA to do his taxes, and I'm like, oh, they have this question on the tax forms. He's like, oh crap. Like, I probably need to tell my accountant to check that box. Like, there might be accountants that have no idea that their clients are actually using it.
Yeah, that's true.
Well, we have organizers, and then it's on the organizer. And then we also have tax caddy. So it goes, it brings it to their attention. But yeah, I mean, and look, if a client comes to me and says, I have all these crypto transactions, but I don't want to report it. I'm not doing the work, right?
Right,
Yeah, that's the end of that conversation.
That's the end of the conversation,
yeah,
right? So
yeah, absolutely.
people really want to do the right thing. They want to report it. They don't, no one wants to pay.
It's what I love about working with businesses is that businesses, they want to report it, but they're also aware of making trade-offs about risk versus reward for that. Like, I love working with businesses because they're going to report it, but they're willing to like kind of take aggressive or conservative stances, and they're willing to say, oh, ETH to ETH is not a trade. Oh, this is not a trade. Like, they're willing to do that. That's actually what's so fun about Bitwave in some ways.
And you disclose it, and you have a reasonable basis for the position, right? And then you can go deeper and deeper to substantial authority. And but the fact of the matter is, you got to have that reasonable basis, and disclose it, and that's fine. So there's white and there's black, and then you're never gonna go to the black because that's illegal, right? And people go to jail for that. But there's different shades of gray, and there's nothing wrong with that. I mean, every position there's some risk attached to it, and it's not just crypto. There's an ambiguity throughout the entire code, and so what you have, that's why it's job security for us. And so you just have to help the clients navigate through that, know their tolerance for risk, and and certainly just keep them within those shades of gray, just far away from the black.
Well, I love you guys. We are at the top of the hour. This has been an absolute joy and pleasure. You guys are both really wonderful to listen to and super knowledgeable about all this. Really interesting. And hopefully everyone who listened got something out of this. The webinar recording will be up on our YouTube channel here pretty shortly. If anyone's interested in reaching out, I believe both of you fine gentlemen are on our partners page. So if you go to the bitwave.io on our partners page, you can find both of their contact information. If any other partners are ever interested in doing one of these kind of webinars, it's one of my favorite things in the world to do because it's just so much fun getting to talk to people who are in this space. So thank you, John. Thank you, Daniel. This was a pleasure, and thank you everyone for attending. And we are looking forward to we'll do another one of these at some point here pretty soon.
Absolutely. Thank you, Pat. Thank you.
All right. Thank you.
Thanks, everybody.
Thank you, everyone. Take care.